Welcome to this webinar. My name is Richard Martin and I'm the Head of Corporate Reporting for the ACCA, the Association of Chartered Certified Accountants, a global body for professional accountants, many countries around the world. We're doing this webinar jointly with Carbon Tracker International, and more of that in a moment. But that's because both ACCA commissioned a report on the climate risks and the extent of disclosure by companies of those climate risks, and we discovered in conversation with Carbon Tracker that they were doing the same, and so it seemed a good idea to perhaps put our efforts together jointly to present the findings, and that's going to be the start. That's the beginning of this webinar. Will be both presentation of the ACCA report, which will be done by the main researcher of that report, Diogenes Baboukatos, who's a lecturer at Essex University, and as I say, has done the main work for us on that report. Following that, we'll have the report from Carbon Tracker, presented by Barbara Davidson, who's working away on their report. The two reports cover the same sort of issue about disclosure of climate risks, but they cover slightly different ground. So the ACCA report is just looking at extractive companies, or oil and gas and mining companies, but from around the world that uses IFRS. So that's essentially the world except for the USA. Whereas Carbon Tracker's report covers different industries as well, includes different industries as well, sectors such as travel and power generation and so on. And it also covers US companies. So there is a similarity of coverage, but there's also a sort of extension complementary nature to them. After we've had those quick summaries of those reports, then we'll switch to a panel discussion, and we're joined by David Pitt-Watson, who is from the Judge Business School and the University of Cambridge currently, but a previous involvement with the UN environmental program and dealing with the finance initiative there very much, and been involved for many years with trying to get finance and investment addressing the question of climate change. So, and we'll also have Caroline Escott, who is the investment manager with Railpen, an important pension fund here in the UK. So that will be that element. We're also looking forward to questions from you participants, and if you can put those questions in the question and answer function that you should see at the bottom of your screens, that would be most helpful, and we'll try and deal with as many as we can of those as we go along. So I'll at this point hand over to Diogenes, who's going to explain the key findings from the ACCA report. Diogenes.
Thanks. So yes, welcome everybody. My name is Diogenes Baboukatos from the University of Essex, and I will present some preliminary results from our study on climate change related disclosures in extractive industries, which is a collaborative project with colleagues from various UK universities, and the project is funded by the ACCA and the Adam Smith Observatory for Corporate Reporting Practices in the University of Glasgow. So our project has two phases, we can say. The first phase, which has already been completed, analyzed the 2019 annual reports of 60 publicly traded companies from extractive industries that apply IFRS, as Richard already mentioned. And we focused on the 60 companies with the largest carbon emissions for the previous period, for the 3-year period before. So we speak about quite large polluters around the world. So we expect these polluters we assume, let's say, that for these polluters, carbon-related disclosures, climate change-related disclosures are vital, important disclosures for the company, but also for the users of the financial statements. The results of this report has already been released in January, and you can find the report on the website of ACCA. Currently, we are working on the second phase, where we analyze the very same companies, but for the 2020 annual reports. So far, we have analyzed 32 companies, and the findings that I will present today are based on these 32 companies, whereas all the comparative information from 2019 are also based on these 32 companies. So as a first stage, like a big picture from our findings, this is the average levels of disclosure that we find based on our research instrument, which is based on 25 items, 11 for the front narrative part of the annual report, and 14 items for the back end. As you can see from our findings over here, that the front end seems to be companies seem to disclose much more information in the front end, and also for the 2020 results, it seems that we have an upward trend from 45% on average in 2019, we go up to 53% in 2020. Whereas if we see on the back end, we don't see any significant change. Basically, the results are very much the same as last year, with the very same median and just a slightly better mean from 2019 to 2020. Now, as Richard mentioned, we have covered quite like a diversified number of companies in terms of their geographical location. I just want to focus in these 4 countries because I think that there are quite interesting findings here. First of all, Canadian firms seem to disclose quite little, which to me it was a bit surprising as a finding. You can see that even for the front end, based at least in our research instrument, only on average they disclose about 25% of the disclosure items in our instrument. In a more positive side, we see that Russian and Brazilian firms get quite better in 2020 compared to 2019, at least in their front end, whereas in the back end still they are lagging a lot behind. Also, I would like to bring your attention France, although it is only one company, and this is Total, which is also quite large company, but I think that this is a good indicative example of a country with heavy legislation in environmental reporting that dates back in the beginning of the 21st century. And probably this is why we see this quite large disclosure level, at least in the front end, which is basically the highest that we find in our sample. Now, moving a bit more in detail in what we found in the front end and later on what we find in the back end, a quite interesting result about the front end, it was related to the business model disclosures. As you can see here, 28 out of the 32 firms in our sample, they do have a dedicated disclosure section about their business model. Still, I think that 4 out of the 32 is quite large, but most of them, they do have a discussion about their business model, and almost all of them, but one, identifies that addressing climate change risk is an integral part of their value creation process. So it is, they identify, at least verbally, they do say that we believe that climate change risk is an important part of our business, of our activities. Also, interestingly, we find that 15 out of these 27 companies in 2020 annual reports, they also refer to some international initiatives, primarily, of course, the Paris Agreement. However, they do not correspond to specific Paris Agreement scenarios. The second item from our findings that I would like to bring to your attention is related to performance indicators. What you see here on the left-hand side, on the large pie, is the number of companies that they do disclose subtype of climate change-related performance indicators. 31 out of the 32, they do so. The type of disclosure of performance indicators that we find predominantly is the level of total emissions. Maybe they distinguish also scope 1 and scope 2. This is what they primarily do. However, I think that it's more interesting what we find on the small pie, what we saw on the small pie on the right-hand side, where we see that 2 out of these 31 companies, they what we call fully integrate this information with some type of financial information. So we find basically ratios, key performance indicators, where they combine both climate change related information and financial information. In both cases, what we find is what we call carbon intensity, so total emissions divided by total revenues. Then we find also 8 companies to engage in what we call partial integration, and that by that we mean that on the very same page we find companies disclosing both their carbon performance indicators but also financial performance indicators. To some extent, at least we think that these companies they think that these two they have some relevance, and this is why they provide this information on the same page. Whereas for the vast majority, 2/3 of our sample, the climate change performance indicators, they are disclosed in a totally separately than the financial performance indicators. Just to mention also that the picture for 2019 that you can see here is that 2020 is slightly better than 2019. We have 2 out of 2 more companies compared to 2019 having performance climate change performance indicators, and basically a few more have engaging in partial integration. Now, moving to the back end, I will focus on 2 elements of this, and these are the non-current assets and the impairment testing disclosures, so the notes. What we find in the non-current assets is not very promising or very positive, I would say. We have very few companies engaging in any type of discussion over the climate change when they discuss the judgments and sources of estimations uncertainty in their accounting policies note, specifically speaking about the non-current assets, whereas none of them considers explicitly climate change as a factor when they estimate the economic useful lives of their assets. We do have a few companies that they disclose or they recognize some type of assets in relation to climate change. So as you can see, the final 2 bullets, 7 companies use financial instruments in order to settle future environmental obligations. We see that predominantly in South Africa, companies that do have specific funds where they put their money for future obligations, and 8 of them also recognize carbon allowances as intangible assets. Now, of course, non-current assets are very much related to impairment testing, and this is why I decided to show you these findings. Now, when it comes to impairment testing, 1/3, basically more than 1/3 of the companies, they recognize climate change as a factor of their judgments and sources of estimation uncertainty in their accounting policies. Definitely much better than when they come for the non-current assets. We have 5 companies, which is the same, and also I should say that this is 12, whereas in 2019 we had only 7, so we have an interesting increase here. Whereas when it comes to estimating the recoverable amount, specifically the future estimated cash flows, we find that 5 companies only recognize climate change as an important factor, whereas 3 companies, the very same 3 companies in both years, they recognize climate change affecting their impairment losses when a company recognizes impairment losses. So all in all, what we find so far is that we have quite an interesting increase, quite substantial increase on the front end, but in the back end, still we lack quite a lot of information. Companies, they do not engage much in discussing about climate change related risks. And also, that also brings to another conclusion that basically we do not see a connection of the front end and the back end. So we can say that to a large extent, these two parts are quite disconnected. So these are for the time being, and I'm very much welcome questions later on. Thanks a lot.
Thanks a lot, Diogenes, and interesting findings in terms of improvements. I mean, say doesn't sound like we're I think it shows not a very good base that in the first place, but some limited improvement. So perhaps there's a bit of hope there. Barbara, do you want to give us now your take on this based on your work? Over to you. Thanks.
Yes. Hello, everyone, and thank you for joining today. Good afternoon, good morning. For those in the US, I'm Barbara Davidson. I'm a senior analyst at Carbon Tracker, Today, I'll speak also about the company reviews we're doing, but from a slightly different perspective. Also, the reasons we're doing the reviews, which are slightly different than the ACCA and the University of Essex reviews. My goal is to hopefully provide investors with additional information as they go through the rest of the 2021 AGM season and as they engage with companies. We're doing a review of 2019-2020 reports, as they had mentioned. And to give you a little bit of background on the review, in November 2020, the Institutional Investors Group on Climate Change, or the IIGCC, wrote to the audit committees and lead audit partners for 36 of Europe's largest companies in the carbon intensive sectors. So that would be, as Richard had mentioned, energy sectors, materials, and transport. Their key ask, and I quote, is that material climate risks associated with the transition to 2050 net zero pathway are fully incorporated into company financial statements. So otherwise said, these investors want companies to reflect the financial effects of achieving the goals of the Paris Agreement in their financial statements. This is separate from front-end or narrative reporting TCFD disclosures, as Diogenes has said. This information will help the investors make capital allocation decisions which are consistent with achieving Paris goals. Carbon Tracker, again, is reviewing 2019 and 2020 annual reports of these 36 companies. We've had a little bit of overlap, as you'll see, with the other academic study, but it's interesting because we can show how the companies have moved on, hopefully, in 2020. We're also looking at 20 US companies, all in the energy sector. And again, a reminder that when I talk about the results, this is fun. When I talk about the results, this is not about the quality of the company's transition. It is about their reporting. So when we look at the company reporting against the IIGCC's expectations or requests, we're looking at whether investors are considering material climate risks, such as the effects of transition risks, when they prepare their financial statements. Again, are they discussing these issues as part of the assumptions and estimates they've used in preparing their financial statements? If they are not, have they explained why they're not? We're looking at if they've disclosed, as Diogenes was saying, quantitative assumptions that they've used. Did they test their quantitative assumptions against credible climate scenarios that would be Paris aligned, such as achieving net zero by 2050? If they haven't used these assumptions, have they at least provided sensitivity of the financial statement items to those assumptions so that investors can understand the effects on a company's financial statements? And are their discussions consistent with their narrative reporting? So we have looked at similar items. Investors also want to see how auditors have addressed these issues during their audits. So they understand how and whether auditors have included the potential effects of these climate-related risks and how they've considered the potential effects of those risks on the assumptions and estimates that companies have used in their financial statements. So have they included these issues as key audit matters over in Europe and the EU? Sorry, Europe and the UK, or in the United States, have they considered these as critical audit matters? Investors also expect auditors to use independent specialists that are appropriate for these issues, such as climate change specialists. We're looking to see if the auditors have scrutinized management's assumptions in the light of climate-related risks. So have they tested these assumptions, again, against credible climate scenarios? Have they indicated whether the assumptions appear to be Paris aligned? And if not, have the auditors also done a scenario analysis to determine the financial effects on the financial statements? Did the auditors know any inconsistencies in the information provided? And did they address whether climate risks would affect the company's ability to continue as a going concern? Our preliminary results have included some noticeable differences between the US and the EU and the UK companies, even though the audit and standards in this area should not be that different. So we can talk a little bit more about why this might be in the panel today. In general, only disclosing possible risks related to climate transition and the Paris Agreement in the front of their 10Ks or their annual filings. Most of the discussions that they include relate to potential policy or legislative changes. Some do publish climate reports or sustainability reports, and they may have climate strategies or targets in those reports as well. None of the companies that we reviewed to date reference climate-related risks in their financial statements of the US companies, sorry. By contrast, the EU and UK companies do reference some of this information in their financial statements. They also, in the front end of their annual reporting, include discussions of how they're aligning their strategies to address climate change, Many, again, identify climate-related financial risks in the front of their reports as well. So in the financial statements, they are split in their disclosures of this information. About 50% of the companies that we've reviewed will reference climate-related issues or risks as having an effect on the significant judgments and estimates that they're using when they prepare the financial statements. We've seen some differences across sectors. So the least amount of information provided is usually by the transportation sector, and then the materials sector, and finally, actually, the energy sector provides the most information so far. But having said that, many still don't disclose quantitative assumptions that they've used in their accounts. Even most of the time, it would be for impairment testing. They don't disclose the quantitative information. If they provide a sensitivity analysis, often they don't disclose the assumptions there either, even if they have already referenced climate risks or Paris goals in their accounts. On these next two slides, I want to provide an example of our assessments in a little bit more detail. And these examples will also illustrate a little bit more the differences across geographies for companies that are operating in the same sector. So here I'm going to compare Chevron and Total, but Total for 2020. So hopefully we'll see a little bit of difference. For Chevron, in the front end of their annual report or their annual filing, their 10K, they discuss possible transition risks such as emissions and climate change regulations and legislation. These could be carbon taxes or increased societal expectations on companies. They have some qualitative discussions of financial impacts of these risks, qualitative, such as increased cost or reduced sales. In their risk factors, interestingly, they note that climate change related issues and responses are factored in their long-range supply, demand, and energy price forecasts. So they do note something in their risk factors. They also publish a separate climate change resilience report in which they discuss their strategic response to a lower carbon economy. They indicate that they don't disclose carbon cost or oil and gas prices, but they do use them, and they provide emissions targets, emissions intensity reduction targets, I should say, for 2028 for information. But you can see that we've given them low ratings against the investor expectations. And this is because in their financial statements, they're not telling a consistent climate change story. So the financial statements are not discussing not reflecting, the discussions that we're seeing in the front end, if you will. For example, they have impairment of almost $3 billion in 2020 of some upstream properties, and they've referenced changes to price forecasts for the impairment, and they've fully impaired their Venezuelan investments in oil and activities, but they have not indicated how climate change issues are factored into their impairment testing, even though they have indicated that they consider these risks in their risk factors in the front end. They don't mention how price assumptions could be affected by transition risks. They don't mention whether they have considered other issues, such as increasing carbon costs in their future cash flows. And they do not disclose any quantitative information. They've also increased their investments in oil and gas activities in 2020, which includes a $15 billion purchase of Noble Energy. By contrast, Total has made more progress towards including the requested information. So again, in the front end, they describe some climate scenarios and targets. They've described their product demand and price scenarios that they have based on IEA climate scenarios. They do discuss transition and physical risk factors that could affect them. And they acknowledge that there are potential financial statement impacts from failing to adapt to the pace of energy transition. And this is still in the front end. They've also announced in May 2020 their climate ambition, which is a net zero ambition for scope 1, 2, and 3 emissions by 2050. And they indicate that those have led to revised assessments of some of their assets. And we've given them medium ratings for their meeting investor expectations, because their financial statements tell a relatively consistent story. Well, there are still a few things we're not sure of, but in their financial statements, in the notes of their financial statements, they discuss how their climate ambition affects the review of their oil assets that they consider could be stranded. And they've defined those with reserves beyond 20 years and high production costs. And they disclose the oil price assumptions that they've used in their impairment testing, both short, medium, and long term. They've explained which IAA scenarios have influenced these prices that they've used. And as a result, they have impairment of $9 billion in 2020, including approximately $7 billion impairment in their Canadian oil sands. However, as I note, there are still some inconsistencies. They discuss some carbon prices that they use in the front end, but they don't discuss any application of these prices in the financial statements. And so these are some things to look into. We also looked at audit reports and for Chevron and Total to see how they've fared against the investor expectations. Chevron's auditors, who are PwC, have included critical audit matters related to the effects of reserves on their upstream property, as well as the valuation of some oil and gas properties for Noble. However, they do not mention the effects or potential effects of climate change risks or company emission targets, et cetera, on these items in their audit reports. So they don't include any of these items in their critical audit matters. They don't mention whether the assumptions that the company uses, that Chevron uses, are Paris aligned, what Paris aligned could look like. They don't perform a sensitivity analysis to try to show what Paris alignment would look like in the financial statements for Chevron. By contrast, Total's auditors, who are KPMG and EY, do include reference to Total's climate ambition in their key audit matters when they're reviewing Total's impairment for certain assets. And so they reference this in their key audit matters. They indicate they have included it as a key audit matter because there's a degree of judgment involved. They compare the prices that Total has used to external third-party data, such as the IEA, but they also don't mention whether they think these assumptions are aligned with Paris or whether they provide a sensitivity analysis. So they still have a little ways to go on the IAGCC expectations. So what's next? We'll finalize our reviews for 2020. And as we do so, we have ongoing discussions with the various investor organizations about our results. We'll also talk to relevant audit and accounting requirements with these investors. We'll also discuss these issues with regulators and emphasize the importance of including these issues in their enforcement reviews. We'll keep in contact with auditors and discuss potential additional work that can be done. We'll present these issues to COP26 champions and continue to have discussions in the run-up to COP. And finally, we'll publish our results publicly of this review in July or August of this year. Thank you. I think I turn back to Richard at this point.
Yep. Thank you very much. And let's, well, I will now turn to our panelists, David Pitt-Watson and Caroline Escott. Hopefully she's there. David, do you want to kick us off with any reactions to those findings?
Yeah, I mean, I think the first, Richard, would be just to say how important this topic is, particularly the back end of the accounts. And as you said, look, I've been involved in this field of climate finance for 25 years, something like that, including chairing the UNET Finance Initiative in the run-up to Paris. And one of the things on which I've been particularly working for the last 2 or 3 years is this huge gap that we have in the way that we are motivating companies. Look, it's pretty clear to me that investors are clear that they don't want companies to be making a profit by the externalization of their costs, by the destruction of the environment, because that doesn't work as for their clients, because what's the point in paying someone a pension in a world that's been destroyed? And by the way, if the world's been destroyed, there will be no pension to pay either. So it doesn't make financial sense in any case. So why is it that companies continue to do this and they continue to pollute? Well, it's because they can make a profit from doing it. And companies are motivated by that profit. That's how the system works. And for example, if a company discovers an oil well today, it can decide that in 25 years' time, it's still going to be pumping oil and getting $80 a barrel out of that oil well for the oil that's coming out and value it on that basis. Therefore, it's very profitable to find more oil. They can decide that a thermal power plant has got a technical life of 50 years. So it's going to go from 2021 to 2071, and it's got 50 years. So we only need to depreciate the cost by 2% every year. But that thermal power plant's got to be gone within 10, 15 years, in which case the depreciation is very high and you make losses on it. And look, we've got some improvements on the narrative reporting and people saying, look, we'd like to do nice green things. But what we haven't got yet, and we must get, is something where people are only declaring profits that are consistent with Paris. But we have made really big strides, Richard. I think the biggest stride in the past 12 months has been that we have absolutely solid, clear guidance from the IASB that when you draw up your accounts, you must include climate considerations where they are material. And I think that's one of the reasons you're seeing differences between Barbara's European companies and the American ones, because we don't yet have that guidance in America, and we're working on trying to get that guidance in America. By the way, the IASB also says you need to show your assumptions, and I'm quite disappointed that we aren't seeing very many of those assumptions coming out yet, because we need to know what those assumptions are before we can tell whether the company is close to being Paris aligned. In terms of being Paris aligned, the PRI, the IIGCC, all the other IIGCCs in Australia and Asia, the International Corporate Governance Network, the PLSA, a whole lot of other investor bodies are very clear they want those assumptions to be consistent with sustainability, to be consistent with Paris. And look, so we don't have that yet. Diogenes and Barbara's things have shown us that. And I think we need to ask ourselves the question, why? And I think the answer to the question why is that the IASB sets the standards, but it doesn't have the ability to enforce those standards. So we have been talking to the auditors who are insisting that they will enforce the standards. Well, I think quite disappointing what we're seeing so far in terms of that enforcement. But the next big group that's got to enforce those standards is the investors. This is the huge challenge. If we can have the accounts of companies drawn up on the basis that profits are made by the valuation of assets in a way which is consistent with sustainability, we take the incentive out to make money, or apparently make money, by investing in what must become stranded assets, where we as investors will lose because they must be stranded, and or if they're not stranded, then they have destroyed the environment. So this is such an important issue, but it is awfully important right now that investors, regulators, companies, auditors get on board with these changes, and that we end up having a financial system where when we look at the accounts, we look at the accounts and the profits that are being declared are sustainable profits, not just financially, but also environmentally. We're getting there.
Thanks very much, David, for those thoughts. I think that leads on to quite a few issues you've raised there, but very grateful for those. Caroline, from Railpen's point of view, what would your reactions be to the findings we've heard and the issues raised?
So at Railpen, we've been working quite closely, and we've been really pleased to see the excellent work that has been produced by Carbon Track and the PRI and Climate Action 100+ and the IGCC on this issue. Maybe just to talk through it from the Railpen perspective and how we are actually engaging and voting using the analysis that has been produced in the 2021 season. So I would probably preface this by saying that Railpen is, I think, your typical investor. We are not auditors or accountants by background within the team. What we do have as an asset is a trustee board within whose investment parameters we operate, which is very passionately committed to climate change, and is always empowering us to think about how we can use the full stewardship toolkit to make our voices heard. And we know that the climate change, big systemic risk, is particularly important to the trustee board. And what we do recognise, as with any major risk facing a company, it makes very little sense for a company to be talking about the huge impact that climate change, again, so the only risk is going to have on its operations in the front end of the accounts and the steps they're taking to mitigate that, without actually factoring some of that analysis and using sort of similar assumptions about the impact climate change is going to have into its financial accounts. You know, the assumptions that they use to value their assets and liabilities, it makes no sense. They don't take account of decarbonisation or the transition. So every year, the RailPen team sits down and we think about what our key engagement voting themes are going to be for the next year. And to us, climate accounting felt like the obvious next step. We knew that there was this good work that we were sort of looking at as part of the Climate Action 100 Plus group that Barbara and others have been doing. And we wanted to see how we could support and use the work in our stewardship to have the greatest amount of impact. So every investor will think about this differently. The process we went through, and hopefully it might be of use to those investors who are on the call, was of course thinking about where you can have impact. The most intensive carbon emitting companies, Climate Action 100 Plus, universe means that this analysis was being undertaken. And then we needed to take a step back and think about the context within which we're all operating. So to what extent could we as an investor already expect companies and auditors to be really talking about and discussing and taking account of key climate change assumptions in the financial accounts, and then thinking about the culture as well. So what is the RailPen approach? And if we looked at the context, it seemed clear to us that Climate Action 100 Plus is already engaging on this, both on climate accounting specifically, but also climate change generally. And going back to my point at the beginning, where you cannot say as a company that you're taking an issue seriously if you're not following the logic all the way through. The point that David was making as well, the rules haven't changed. The IASB is clear on the company side. The IASB is clear on the audit side. They should be reflecting climate change in their planning and execution. And so we felt pretty comfortable that where companies weren't doing what the analysis and what we've then considered to be a good job, that we could probably be a bit bolshier on it sort of this time around. Going to our culture at RailPen, we have a trustee board that encourages us to be robust with our vote in a way that is aligned with our engagement work. And also in terms of mechanisms, we have published a voting policy every year since 1992 with new updates every year. And we use this opportunity to drive forward the conversation with our direct holdings. So what we decided to do, and we have been doing in the later part of 2020 and the early part of 21, is putting in new lines on climate accounting, which are available for anyone to see on our website, where we highlighted our expectation that highly carbon intensive companies should be very clearly disclosing the assumptions that they're using with regards to climate change. We would expect to see a discussion in the auditor's report as well. We expect there to be some evidence that the company, the auditors, have kicked the tires on this a bit in a really meaningful way. We have been engaging with the direct holdings on this as well. Where necessary, we've been looking to arrange a follow-up conversation with the audit committee as we try to influence that mechanism as well. We've been getting closely involved in some of the IAGCC and Climate Action 100 climate accounting specific work, so supporting this letter that Barbara was talking about earlier as well. And in addition to this, we have also been, and in fact we have already undertaken our first voting activity, and then against the same, on climate accounting, using as one type of input some of the analysis that has been provided to us, and which has been really helpful. And without wanting to go on for too long, but just very quickly, I can talk about the specifics later in the discussion. That's helpful. But of course, when it comes to thinking about a vote, there are really sort of a number of different ways of looking at a number of different mechanisms. So of course, there's the report and account. Can be a bit nebulous, but you can see that where the numbers in the account do not reflect the promises that a company is making elsewhere in the report, that might be a particular issue. You could, of course, vote against directors, so the audit committee chair or members of the audit committee. For us at this stage, seeing as it's still, although we think companies should really be taking account of this, but we're still at an emerging stage of the engagement process as an industry. That's probably not for us this year, except in particularly egregious instances of behaviour. that will probably be something we look at next year and going forward. And then, of course, the auditors as well, remuneration and reappointment. So, you know, at that stage, we as an investor have to take a decision as to whether we feel it's a company responsibility where we've had concerns, or whether it's more on the auditor side. And so we have actually just a few weeks ago, as I said, exercised our first pilot vote, which I can take us through. Every time we will take this decision, we will, of course, not just blindly use the very excellent analysis that's being produced, but of course, this is any decision, you cross-reference it against the willingness of the company to engage, against the other sources of intelligence we have about the particular approach that company, all their auditors have taken as well. But you know, we're really supportive of this entire agenda. I would highly recommend the work that has been done, and the more investors that you know take advantage of the analysis that is being produced in the 2021 AGM season and in the engagement either before or after in the future. I think that is all to the good. Great,
thanks. I mean, you've outlined a number of initiatives you're taking there. I think initiatives before you start voting against the adoption of the accounts, you're going to be presumably encouraging putting forward motions which are trying to get behaviour remedied rather than actually vote against. Is that right, Caroline? And are you getting enough support from other investors in doing this?
So I would say that you know, we do have bilateral conversations with other investors, particularly when it comes to getting to grips with the company with whom we might not have engaged as much as others. So to really understand their climate approach and the other sort of leaders supporting investors in Climate Action 100+ are really valuable source of information for that. I would say that I think as a house, we would argue that investors generally are possibly a bit too shy of using the vote to publicly express dissatisfaction with the way in which a company has handled an issue. I would say that yes, you know, engagement beforehand is good, but at the same time, on things like climate accounting or the climate change piece, these conversations have been had for quite a long time, and any company that is really serious, taking a really serious look at the impact of climate change should be following that logic. I would also say that, you know, with apologies for John Dunn, but no investor is an island. So we think that so we think that our voting behaviour sets a positive context for other investors' engagement where they feel, you know, like they can't yet commit to a vote. You know, they might have multiple different clients or other considerations. In the same way that their engagement sets a positive context for our voting behaviour as well. So in terms of support from other investors, I think as long as everyone is aiming for the same goal, it doesn't necessarily matter that we're not all taking the same stewardship activity at the same time, if you see what I mean. I think it all helps to positively reinforce what everyone's doing. Yeah.
Okay, great. I think David raised a number of what other parties ought to be doing. We've had a question about companies behaviour, which I want to bring in. We've had this question about what do we think is the main reason why companies are not disclosing, are not treating this issue in the financial statements? Is it the fear of lawsuits from stakeholders, or a fear of share prices falling, their share price falling, or maybe they're still figuring it out, is the question. Anybody want to comment on that?
I'll go quickly.
Yep. Okay.
I mean, if I'm okay, I think in general, the company, you know, if we assume that companies are trying to do the right thing, then in general, we can say, well, these are now becoming more and more material issues today, right? Before they were emerging risks. Now they're material today. On some of the bigger companies, if I provide a more skeptical outlook, I think that they just haven't had the right amount of pressure from regulators or investors. And so, because as we've said, the accounting policies are always required this. And I would argue, even with what David said, I think US GAAP clearly requires this too. And so there just hasn't been enough pressure put on these companies to provide the information from a skeptical point of view. So now that these are risks today and they're not emerging anymore. So that's my two sides of the.
Okay, all right, David. So
yeah, look, I think that is right. As Caroline said, the accounting standards have not changed. Accounting interpretation from the standard setter has changed, in the sense that we now have a very clear statement from the IASB that if you want to use our standards, climate where material needs to be included, and you should be showing your assumptions to investors. And by the way, it's material because of all the work that investors have been doing over years, saying how important it is, you know, climate action 100+ and 54 trillion and PRI and IGCC and all of those sorts of things. So I think that for this to happen, there needs to be some pressure on the company. It is, I think, hugely to the company's advantage because to do this now, because if you don't, all your numbers are filled with profits that are going to be stranded if we resolve the climate issue. And if we don't resolve the climate issue, everybody has a much worse problem. But in the short term, the thing is, Richard, it will affect the profitability that you're showing, won't it? It will. Yep. You need to go back and say, look, that oil well in the Arctic, we're not drilling it any longer because it's not going to be profitable. That thermal power plant, we're not building it any longer because it's not going to be. So it is difficult for the companies, but actually the long-term safe thing for them to do, if they want to avoid lawsuits, and I do mean avoid lawsuits because there will be lawsuits if they don't start accounting properly, is to make sure you've read the guidance from the IASB, you've thought about the underpinning of the accounting standards in the United States, that you're thinking about the material climate issues, that you're using assumptions that are consistent with sustainability, not consistent with unsustainability. And when you show your balance sheet, you're showing one that is not chock full of stranded assets. And therefore, when you compare the two balance sheets, you get your profit and loss account. And that is a profit that has been earned consistent with a sustainable planet. So I think there's lots of little things that are stopping people, but it's hugely to the company's advantage to embrace this now and not to wait for the lawsuit.
Yeah.
I'm successfully unmuted again. So I was just going to add that I agree with everything that Barbara and David have said. And I would also just say that investors on audit issues generally have, I think, not been very good on engaging with the relevant people. You know, there was a reason that the Brighton Review, for instance, recommended a number of different mechanisms. I hope you're going to see be implemented by those, recommended a number of different mechanisms to try to encourage investors to engage with the auditor, even just to make their expectations clear as well. Hopefully, there's a two-way feedback mechanism. So hopefully, if we do get more investors engaging on climate change and financial accounts with the audit committee, making their expectations clear to the auditor, that will hopefully help feed through to a more productive dialogue on audit issues generally, which will be helpful for all parties. But you know, I definitely agree that part of the issue is, I think, that, you know, there's nervousness from companies, but part is that investors just quite often you can see their eyes glaze over when you talk about financial accounts and audits. I saw that when I was at the Pension Lifetime Savings Association, trying to get investors in the same room to discuss audit issues, like drawing blood from a stone.
Is that right? Yeah. Yes. Okay. Anybody else want to? Yeah. Diogenes.
Just one more comment. I totally agree with all previous comments, but I think that it is important to emphasize also the role of having a consistent policies across different jurisdictions. Because if the policies are much stronger in favor of changes in carbon in Europe, for instance, in the UK and so on, but on the other side of the pond, the regulation is not so strict, or companies, they can feel still that they can find a way out, keep polluting, keep using oil and so on, then I wouldn't, we cannot expect that will go very far away. So,
And I think that has been raised by a question we've had from the audience about the cost of capital and trying to sort of companies feeling that the more perhaps some more disclosures they put in there or more effect they report in their financial statements, that their cost of capital is being affected adversely compared to competitors. And I guess that's to some extent about regulation. So I suppose that's the other group of people who we've talked about, the investors, we've talked about the companies, I suppose the other, and to some extent we've been talking about the auditors. The other fourth group involved here are regulators. We've heard about the IASB's initiatives, which are sort of educational and pointing out that the standards already require some of this. It's not more needed perhaps from some of the securities regulators involved here. I don't know, anybody, were you nodding there, Barbara? Do you want to say something? What else should we be expecting regulators to do really to help investors?
Can I make a quick, I have a comment about the regulators. I just wanted to make a very quick response also to Diakonis, because I think regardless of whether there are policies, it's important for investors to understand if management has considered these issues. And so investors would like to have an understanding of what management has considered, because these are material risks in their financial statements. So even if the companies in the US who don't think there are policies that will affect them, which is could be true, investors want to understand that the companies have considered that. So that should still be disclosed.
Yeah.
With respect to regulators, so the FRC did a climate thematic last year, and they did start looking at financial statements, and they did start calling it out for the auditors and for the companies. And so I think that regulators need to follow that lead. The securities regulators need to start putting these issues in their enforcement reviews. The SEC particularly needs to start looking at it now. They are doing a consultation, and we will respond to that. But the consultation is some maybe a more general issue, and the SEC already has rules today that basically says if you have used assumptions in the front end, so in the front end of your 10K, say, for planning or other purposes, then there should not be a difference in the assumptions that you use in your financial statements. And so again, I think even though we need better maybe clarity from the US today, we already have the requirements in place for US companies to put this in place.
Sure. Yep.
I think
David. Yeah.
I mean, yeah, we need the regulators involved, but people always want to say, oh, this is the regulator's job, or this is somebody's job, or this is somebody else's job. I think when we think about climate finance, it's actually quite helpful to think about this as an ecosystem. That there's a part to play for everyone. And if they start playing their part and asking others to play their role, that actually we will get some very good results on all of this. I suspect, for example, that when Barbara and Diogenes have finished their work, they'll see that UK companies are doing not too badly. Why? Because there's been a group of UK investors that have been pushing this, because the FRC, the regulator, has been saying stuff about it, and because the professional bodies have been supportive of this, Richard, like the ACCA and the IAASB, and that is what we need. And it needs to become normal and sensible that companies start accounting for their profitability and thinking about the new projects that they're going to invest in as being ones that are consistent with sustainability. If we get that, we take off the table this huge danger of stranded assets, which could create a financial crisis when they all need to get written off. And we start to have companies moving towards sustainability. And you know, the guidance that we've had from the IASB, by the way, is also the IAASB, the auditors, also the letter from the PRI and IGCC and all of these sorts of things. They come together as an ecosystem. And the end result of this is just stop making money by externalizing.
Yep. Okay. I did want to ask Diogenes and Barbara, actually, in your two surveys, do you see in any way that perhaps reporting has turned a corner in 2020 compared to 2019? We've heard a bit from Diogenes's numbers. I just wonder, do we feel that's happened at all or not?
I think that the reporting is getting better. Some of it is getting better. We're definitely we're seeing more information in company financial statements. I don't want it to be all doom and gloom. I know that they're not meeting the expectations yet, but yes, you can see improvement. We can see some definite improvements between companies. And I would also wanted to say a positive thing. So, for example, I know there's still ways to go, and I'm not commenting on climate policies, but BP's audit report by Deloitte has a lot of information in it this year, and they've really stepped up and tried, or they're moving towards meeting these investor expectations on the IIGCC side. They haven't met all of them yet, but they're doing a lot of work. So there are efforts being made by the various parties, and yes, I have seen some improvement. Not enough.
Not enough, right? Diogenes.
I would probably be on the same page as Barbara, and basically I wanted indeed to mention BP in that sense, because in BP you can see a clear connection to some extent of the front and the back end, especially when it comes to impairment testing and how and what assumptions they make and what scenarios they follow. And there is even a cross-reference within this report that if you want to learn more about that, you have to go to that page, which is very helpful. And it shows that there is this connection with this interplay from the back and front end. Yep. Of course, not everybody is like BP. Of course, BP has its own shortcomings as well, but also other companies. What I see as a bit more optimistic is that even in parts of the world that I wouldn't expect, so companies from parts of the world that I didn't expect to see an increase in the volume of the disclosures, I see this increase in the volumes. And this I'm saying outside the Western countries, the Western European countries.
So this is your sort of Brazil and Russia sort of examples.
Exactly.
Yeah. Well, that is good.
And I think that this is quite. If we want to say something positive as we are close to finish, I would say that this is the positive thing, that we see an upward trend.
Okay. Can I also just ask, and for everybody really, obviously these two studies concentrated on certain sectors that we know are very heavily impacted potentially by climate change, the energy sector and so on, travel. Are there any companies that are reporting who shouldn't be worrying about this, or do we think most companies have got to start addressing climate change in their reporting and strategy and so on? David, have we got the right? Obviously, we've concentrated on the most important, probably the most significant. But what do you think about this sort of general?
I think everyone needs to think about it. And indeed, if you're declaring on the front end that you've got a great climate plan, and then you've got absolutely nothing that has gone into your financial numbers, that would give me grave concern that you're continuing to work as normal whilst making great statements up front. I mean, the really interesting and neat thing about BP was actually, Deloitte in 2019, it was really the first one, declared that the front end and the back end at BP were incompatible. And when they issued the accounts the following quarter, BP made a big write-off and completely revamped all its exploration expenditure. Now, the thing that you really want is revamping all your exploration expenditure. That was what investors want, because they want an oil company that will run itself down and do what it needs to do to be clean by 2050 and so on. So I think all companies need to be thinking about this, and some are. There was a question as well just that was coming up about other good companies in the UK, Rios and Anglos, I think. Barbara, would be ones I would have a look at what they're doing. That seems good. But I'd always think about what we're trying to do here is to have impact, and the impact is that we're investing in safe companies that are going to trade sustainably.
Yeah, Caroline, have you got any views on sectors? Are there other sectors the ones we've been talking about principally? Are there other ones where Railpen is active, wanting to see disclosures front end and back end on the climate issue?
Yes, so I agree with David that we're focusing on where we think it will have the most impact, which naturally leads to climate action 100 plus companies. But we at Railpen also have an exposure, actually not so much to the very highly carbon intensive companies, or at least companies which have not historically been a focus, the particular industries and sectors that we've discussed. So we are, for instance, invested in quite a lot of technology firms. And of course, some of the practices of these technology firms also cause significant emissions, even if they're not as globally significant as some of the others. So for us, this is an issue in our voting policy. It's a line in our voting policy, even though we say particularly focused on the most highly carbon intensive firms, but it's something that we would want to see all of the firms in our portfolio really think about the approach that is meaningful for them. As David said, the consistency point is key. And when you think about the risks from climate change, it is the physical risk and kind of transition risk, and really regulators and policymakers becoming so active across lots of different sectors in terms of what they're expecting to see, even in terms of reporting requirements, or thinking about use of plastics and packaging and things like that, that it is very hard to see that a particular company that could just say, really, we don't think climate change is a particular risk to us at all. And in fact, if you look at the front end, nearly every company, certainly in our portfolio, is saying that climate change really matters to them, and they're really focused on making sure that they have a positive impact. And even those steps themselves will have a cost and will have an impact. So, it's hard for us to say that there is a company where we wouldn't be wanting to see that consistency, wouldn't be wanting to see some discussion as well.
Yeah, good. Okay. Any last comments from anybody just before we close? But otherwise, I think we've had quite a bit of ideas of what investors, the companies, the regulators, the auditors ought to be doing in this space, and in David's sort of coordinated ecosystem idea. I think that's a good one. We've obviously concentrated on some really key sectors, but we've also noted that it probably applies more generally, and people should be looking at these things. We've, I think, hopefully given plenty of emphasis on the importance of the coordination of what's being said at the front, in the front end, in terms of the strategy, the general company approach, and its proper reflection in the financial statements that support that. So I hope that's been helpful. David, you've raised your hand. You'd want to.
There was just one question that was asked a couple of times, which was,
oh yes,
people have access to the reports that we're doing?
Oh yes, sorry. Yeah, good idea. Yep.
Richard, some of these are being written so that you can. Others will need to stay private, but most of them will be being distributed through Climate Action 100+. So if you're a member of Climate Action 100+, if you go back through the PRI IGCC series, the people that are coordinating that. But if you're very keen on some of these, yes, send us an email and we will see what we can do. Particularly interesting if you can just say, here's the 10 companies I'm interested in. If you're doing these, we'll send you the 5 or 6 from the 10 that we're doing. But we'd like everyone to have as much access as we can possibly give them.
Yeah,
okay, actually, that's great for those. Sorry, Barbara. Yeah, go ahead.
I'm sorry. If David he's right. I put up IIGCC in series as well. So we can also distribute through IIGCC in series. So if there are investors on the call that are linked to them, then they can please get a hold of IIGCC and IIGCC in series.
And obviously, in terms of public reports, I think, Barbara, you've said you'll be publishing yours as a public report in July. We've already reported, we've published the one on the 2019 reports that Diogenes and his team did on the ACCA website, and that will be followed up by more, certainly by the end of the summer. We'll be publishing the following up with the 2020 results as public reports. Good. Thanks, David, for highlighting that for us. Anyway, so participants, I hope that's been helpful to you. As I say, I think we've covered what we could in the time, so have a good rest of the day. Many thanks to the researchers, Barbara and Diogenes, and of course to the panelists, David and Caroline. Right. Okay. Anyway, goodbye.
Thanks, Richard.